Ladies and gentlemen, good afternoon. Welcome to the valuation session of NPL Days 2021, organized by DD Talks. My name is Tassos Kotzanastassis. I'm the founder and managing director of AG Capital Partners, a private equity firm with principal and advisory activities in Asia and Europe. I'm delighted to moderate today's session on valuations, and we have a great lineup of panelists, which comprises Antón Alfaya, Managing Director of Debt Services EBRD TDX Indigo. We have Burkhard Heppe, Chief Technology Officer at NPL Markets. We have Declan Reid, Managing Director at LCM Partners, Emiliano Lazzaro, Head of Loan Advisory at CBRE, and last but not least, Marko Lazarevic, Principal Banker at EBRD. Gentlemen, welcome all, and thank you very much for being with us. Would you like to take 30 to 60 seconds to tell us what each one does? Shall we take it in alphabetical order? So, Antón.
Thank you, Tassos, and thank you, DD Talks. I'm, as Tassos mentioned, I work in TDX Indigo, that is the company within Equifax group responsible for the debt management services. So provide services around collections, recoveries, and as well valuation of portfolios. And we are actually supporting customers in Spain, Portugal, and the Latin region. Great.
Burkhard.
Hi, Burkhard Heppe, Chief Technology Officer and co-founder of NPL Markets. We are a relatively new 2.5-year-old marketplace for illiquid loans, performing and non-performing, operating across Europe. My background is that of an investment banker, 13 years in London in structured finance, securitization, and then recently 10 years as a credit risk specialist at my previous company, Open Source Investor Services.
Wonderful. Declan?
Hi, thank you, Tassos, and thanks, DD Talks, for hosting this conversation. As Tassos mentioned, I'm a managing director with LCM Partners. We're a regulated asset manager with over 20 years of investment experience purchasing secured and unsecured portfolios across Europe, from individual consumer loans to SMEs to small corporates, both through bilateral sales and auction processes, which are obviously more frequent. Our sister company, Link Financial Group, is an established servicer with over 800 staff across Europe that services our investments for us. We're currently investing a 4 billion credit opportunities fund, and we see all portfolios of all shapes and sizes, from global, regional, local banks, bad banks, investment funds, even as small as local credit unions. So looking forward to the discussion.
Brilliant, thanks for that. Marko?
Thank you, Tassos. I'm Marko Lazarevic, Principal Banker at EBRD. I'm part of Financial Institution Group and specializing in NPL investments. I'm coordinating all EBRD's investments in this space. And as a development bank, we're actually investing in quite a range of different products here. We are co-investing in NPL portfolios, but we're also doing direct investments in NPL servicers and platforms in the form of equity or debt. Our geographic focus is Central and Eastern Europe, Greece, Turkey, and our focus is now slowly shifting as well a bit towards East. So we're considering other more frontier markets. This is
frontier markets such as Central Asia,
let's say Ukraine or Central Asia.
Okay, brilliant. Gents, thank you all very much for the introduction. Let's kick off with the recent developments on pricing of NPL transactions. Would you mind giving us a brief snapshot of what's happening in each of your regions? Perhaps we can start with Declan, UK, Ireland.
Yeah, I think following, I guess, the first phase of the COVID lockdown, we've started to see recovery in portfolio sales processes. So banks are bringing back processes to market that may have started and been put on hold previously. In terms of pricing, there is definitely some COVID discounts out there, either in the form of a higher required return or simply lower pricing this is being, I suppose, countered by the attempts by some to make better use of leverage to sustain pricing to acceptable levels to sellers. So there's a bit of a push and pull in pricing right now that we're seeing.
Okay. Burkhard?
Yeah, so we see in different jurisdictions, different developments, starting with maybe the most benign environment in the Nordic region, where sales of consumer retail non-performing loans have continued pretty much throughout last year. Prices are high and have always been high, and they have seen very little, at most a 5% or so discount because of COVID. Of course, the further south, the further east one goes, the more uncertainty grows, and also the impact of COVID is more strongly felt. We have seen quite a few transactions in Italy having been put on hold or demanded a repricing. I'm talking middle of last year. Now, there has been a gradual recovery. You can see that very well in the traded loan markets, that prices are in large syndicated leverage loans are pretty much back to where they were pre-COVID. So clearly some form of normalization has happened, but I don't think we are back to normal yet in regards illiquid portfolios, regarding corporate secured portfolios, real estate secured portfolios. There's still in the whole real estate sector uncertainty about pricing, which means yes, a lot of available cash is there to looking for investments, but sellers have been cautious and reluctant to bring new deals to the market. So that I think that normalization is something that we will see more of early this year, but we're not quite there yet. We're not quite back to normal.
In terms of Southern Europe, are we seeing a similar recovery or interest from investors, or is it the case that NPL buyers are shifting into more familiar markets or better jurisdictions? Is there a flight to quality? So Spain, Italy, Turkey, even Greece?
From my perspective, investors look at deals that are being offered. Yeah, so there's definitely, when you bring a new deal to the market, at least a dozen investors will take a serious look at it, and that applies also to the south. Yeah, it's definitely also in Italy. The market also, I don't want to give the impression that the market closed completely. Yeah, the market, Italy has been historically the most active market for non-performing loan sales in recent years, and the market never stopped completely. Even so, larger transactions were done, mainly unsecured. Yeah, not the real estate, as I mentioned, the more complex transactions have suffered a bit more because of higher uncertainty. But it's yes, so there is definitely activity throughout. Flight to quality. It's difficult to say because there are very few investors who are equally spread around the entire continent. Yeah, people either focus in the Nordics or they focus in the south. Few players play in both markets.
Okay, so how about Marko, Emiliano, or even Antón, who are focusing on the south? What's your experience?
So I would also kind of split this region where we're focusing between CE and, let's say, Greece, and they were in a very different state of the cycle as well. So C started earlier in terms of offloading the previous backlog of NPLs, and to the great extent in most of the countries the NPL ratios were already quite low, and the banks did not have massive amounts of NPLs. So even pre-COVID we saw a slowdown in market activity there, and there were really no major transaction that came to the market in the last, let's say, 1 year during this COVID pandemic. I think there is still good demand in that area. I think that the sellers, are a bit cautious and checking what's happening. They will also try to assess the damage in their balance sheet from the last crisis. So it's very early to say how the prices are moving as well. But again, giving a solid demand, which we also believe did not really shift much to the West. Again, a lot of these players are regional players, and we feel like there is still a lot of liquid demand in that area. We don't expect that prices will actually move much. In Greece, the transactions continued at a bit slower pace than before, but there were still a lot of important transactions. That was simply because of the huge backlog of outstanding loans. They were not cleaned from the previous crisis, and there was a big pressure on the banks to keep cleaning it. When it comes to demand was still there, and the prices moved very little, if at all. So we haven't seen a big impact there yet. And I think at this stage, I think that we haven't seen much movement on the real estate market. We haven't seen much on other asset classes within the NPL space. So I think that the investors are looking at it pretty unchanged, and it will be interesting. I think where investors got smarter is that they know Greece now a bit better. They know what to expect from these portfolios. A lot of these investors that are looking now to purchase portfolios already purchased a portfolio or two in the last few years. So they're coming with much more experience in terms of what is realistic to achieve in terms of the business plan, but we haven't seen a big adjustment in terms of expected IRR.
Okay, but save for the COVID premium, it sounds like pricing is still strong and based on leverage. So do we suddenly see a surge of loan-to-loan availability, even in countries like Italy or Greece, where the banking systems are particularly strained? Emiliano or Marko, or even Antón?
I'm sorry, I will make a little introduction because you forgot me for the introduction earlier. So that's fine. Don't worry. No, just to explain what I do. So I do I had two lines of business. One side I do mark-to-market loan valuation for performing loans that give me a little bit advantage in seeing things a little bit before they go on the non-performing to performing side. On the other side, I had the team for NPL transactions. As a CBRE, we cover EMEA. Of course, we have three local teams specialized in three particular areas that are considered the most hot. They are Italy, Spain, and Portugal. Myself, I focus mostly on UK, Ireland, France, and Germany, I would say. Now, in terms of the market trend, we see a lot of investors interested in purchasing NPL portfolio. Clearly, there is a lot of appetite. We also see a lot of holding. So one side we see the seller, they're ready to sell, but at the same time they don't know exactly is the right moment yet because they don't want to bear the cost of a loss. On the other side, we have the purchasing part, the buyers that are waiting to see maybe there is a better time to buy at a better price. So this gap is still not fulfilled. We saw last year there was not much many transactions actually in the market. This year we were expecting to see more transactions. Right now is still linked to the fact one, the government support clearly on one side, on the other one the fact that we don't know yet how this vaccine is working or when normality or subnormality will come back in place. In terms of geography, I think I still see, even if I don't cover it directly, Spain and Italy remain the main market. I see less interest in Cyprus and Greece, to be honest. I think and I expect a bigger market in France, UK, Ireland. We already see the first transactions. So I think we are still in a phase we are on hold, but sooner or later, I mean, the gap between the buyer and the seller will fill up, and we will see many transactions. And if I may say last thing, I think the government support is actually having the effect of sliding down in time, a little bit postponing the effect of coming into the market. So I don't think that is the. I read many reports, the quiet before the storm. I think that is the case.
Quiet before the storm. Okay. So in terms of the leverage, which I find particularly intriguing, is there suddenly a surge? Antón? So it sounds like the pricing is being boosted by leverage, which sort of wasn't maybe there 18, 24 months ago. So are we seeing a sort of a bubble in pricing based on leverage?
What we have seen over here, at least in Spain, is that with the lockdown, all the transactions were frozen and they have been reactivated, but mostly in the secure spectrum. The secure ones have not been very active in the end of 2020. And what we have seen in terms of pricing is one characteristic is that there is a biggest dispersion in pricing. So when before the lockdown, you could see a difference in pricings in the different investors related in the transactions, plus or minus 20 or 30%. We have seen difference of 2 or 3 times the biggest against the lowest prices. So it's a biggest dispersion. We were expecting kind of the decline in prices, taking into account the COVID effect, around 20, 25, 30%. And finally, we have not seen that big impact in pricing, mainly due, I think, to certain investors being quite aggressive in terms of putting prices almost the same that it was before the COVID. There are many reasons behind that aggressiveness in these unsecure transactions. Mainly is opportunity. Second is kind of the need to feed the teams and the services behind these investors. In the case of the secure, we have seen little activity, small transactions, and mainly in the secondary market, I would say.
Okay, this point about the secondary market is quite interesting. Do you guys see that investors are now targeting the secondary market, which perhaps offers better opportunities if the pricing in the primary market is so hot? What's your experience?
I think it comes back to a point that Marko made. If people bring portfolios to the market, there will be buyers willing to look at them. I think we're starting to see more volume in the secondary space as a result of portfolios that were previously sold, a number of years ago as a result of the global financial crisis. So there is more to look at in that space, and I think that will continue. That's been another reason why I believe some primary sales have accelerated. It's you do have remnant distressed pockets of distress within banks' books, and they need to clear those out to make way for the new wave of distress coming post-COVID.
So is there more opportunity in the secondary market in less liquid markets, or maybe in markets where bigger volumes of NPLs are expected to come in the market?
Yeah, we definitely see it where there have been larger sales processes in the past. So the secondaries are usually a result of where a primary purchaser has run a particular strategy that they see as their core. And once they've kind of gotten to the end of that strategy, they're willing to pass it on to another owner who may have a slightly different approach or skill set.
So the so-called the tail end. Marko, is there a secondary market to speak of in Southern Eastern Europe?
We expect that it should show up. It should be stronger. I mean, we haven't seen a huge changes of the hands in this region yet, and it would be mostly in the area of really tail portfolios, or in some cases, but it's very rare cases of one of the players leaving the market and selling the portfolios they have. Haven't happened on a massive scale yet. And similarly in Greece, we still haven't seen a massive secondary transactions happening, even though we would expect that from this very large transactions that happened in the last few years, maybe another 1 or 2 years down the line, where as it was mentioned, some of the servicers might exhaust the options or strategies that are applying. There would be some of the reshuffle, but we haven't seen much of the activity in that area yet. And more maybe in a single name and single tickets, much more than I would say parts or pieces of entire portfolios.
Okay. So we've got active markets in both the primary and the secondary space. So is it fair to say that pricing and valuation now is more efficient? We have more data points, so pricing is tighter, even though it contradicts with some of the points that Antón said in terms of the dispersion. Do you generally feel that pricing is tighter and less uncertain? And of course, the answer may vary across regions.
I think we have, as I mentioned before, we have kind of certain investors that have been present in the market and have bought several transactions in the past. So they have more data. But what we are seeing is that as there is new entrants, they are asking for this benchmark or data, and they do not have those precedent benchmarks or portfolios to look after. So in general, I would say that, yeah, we have better data, and in many cases, the investors have longer periods to observe. But as new entrants are getting in the market, they are not having as much as certainty in the transaction and the pricing, and probably this is one of the factors in terms of dispersion I mentioned before in terms of the pricing in the transaction.
So are you saying that investors are using internal underwriting teams as opposed to hire some external who probably has a broader view of the portfolio?
Combination, I would say, yeah.
Okay.
Yeah. In many cases, what we are seeing is that, for example, the role that we provide is certain support and benchmark for some of these clients or investors. And what we are seeing is many of them that in the past were not asking for benchmarks or support for to check their own assumptions, they are asking more now. I think it's quite rational in terms of the uncertainty that we are going through. They are asking for more data or more basis points to check and double check their own assumptions.
Okay, before we.
May I add something before you?
Yeah.
The secondary market. I mean, we should consider from one side we have a regulation going into effect, or at least should go into effect. So there is an attempt to regulate the secondary market. From my personal perspective, I think there is more residual part of the portfolio, anyway, part that not be worked well yet. And there is an attempt to sell this part out of their portfolios in order to invest for newer portfolio coming to the market. So I think there is an interest in being more active in the new purchases of the portfolio coming to the market. And this is also because when you mentioned also the prices, I think that in the past we maybe been a little bit overpriced the portfolio compared to now. If we would have known what is the situation today, more probably would be a little bit more cautious. So there is this attempt to be more aggressive in this moment of time when there will be time compared to what has been spent before. So I see that is a combination a little bit of both. One last thing, you mentioned also the LTV. Now the LTV has an impact when we can assess the real estate value. I heard a couple of times that we're referring also to unsecured portfolio. When we go to real estate value, clearly the pandemic has put at risk the ability to assess the real value of the asset. That's increasing the LTV. Now, that I can tell you that from my perspective on the performing loans, we see an increase of higher LTV compared to the past, but this is normally because of clearly if the value of the asset is going down, the exposure is going higher. So we had this impact, and this is reasonable to understand the reasons.
Okay, thanks for that. In terms of the bid to ask spread, we have two sets of valuation, one for the bid, one for the ask. Talking about the vendors, are there any structural reasons why their valuations would differ massively from the buyers? Or is it just a matter of trying to reduce the losses, or even in some cases are not able to stomach the losses?
Yeah, I can take that maybe. Clearly, there is the banks as sellers. They have a different way of valuing their book, and they must use a different way of valuing their book. So, calculating loan loss provisions, net book value based on IFRS 9, for example, very clear guidance on how that is to be done, and it's very different from a fair value calculation from a market price estimate. So, the discount rate is the effective interest rate that is typically significantly lower than market discount rates, IRR expectations. So that bid offer spread, then there's cost, transaction costs, there are due diligence costs, servicing costs that play a role, and that a bank treats differently from an investor. So the bid offer spread in a way between a bank and a non-bank investor is quite, say, natural. On the other hand, there are some recent developments on the prudential backstop, which means that not all the costs are figured into the net book value from a bank's perspective. There's an expectation, all defaults after 2019, April 2019, will be subject to that prudential backstop, and unsecured loans in 3 years will have a full deduction from capital. That puts a huge incentive on banks to sell, even if their price is below net book value. Once it's a deduction from capital, and it is almost automatically more attractive to have it sold than to hold on to it. Okay. So, and we see banks who have so large European banks who have traditionally not sold much at all. We see them prepare their revaluation, market valuations to assess, in the light of the prudential backstop, what is the best strategy to take and sell, maybe not early 2021, but in the next year or two for sure, because there will be a significant part of the NPL books that is extremely inefficient to hold. So in terms of market efficiency, efficiency of the secondary market, price, similar expected pricing from different investors, I would say I second what Antón has said. There are some segments of the market. I can think of some Eastern European sale of forward flow transactions that price very tightly. The largest bid and the lowest bid are within a couple of percent, if not within 1%. Okay. In Italy, in the mixed portfolios we typically see in Italy, there can easily be a factor of 2 between the highest and the lowest bid. And so what does that mean? It means that just picking your 1 or 2 or 3 investors that you have sold to before is not a very efficient strategy. It makes sense to cast the net a bit wider and invite some new investors who enter the market aggressively. And so I think from that perspective, yes, we heard from Italian banks in the middle of the crisis, April, May 2020, 2 or 3 players were very active and were very reliable in continuing with their bids and closing the deals. But I think as a market normalizes, the strategy of just working with your established counterparties it doesn't give you the best price necessarily.
It makes sense. Okay, it's natural to expect a bid-ask spread, but do we see convergence in the light of transactions, or we still see each side holding up their arguments and just seeing what happens in the transaction?
I do think we see some convergence, and it's usually with a bit of effort. So recently in Ireland, AIB specifically brought a mortgage book to the market with a set of resolution strategies in mind, and tried to attract buyers that could price it based on their expectation that certain resolution strategies would be delivered. So they went to great lengths to create a situation that would trade by trying to create more than usual alignment between seller and buyer, and that was successful. I think to Burkhard's point, where we've seen trade continue is where you have a more sophisticated seller and a much more developed secondary market where flow agreements are tight and they are very competitive. You're very unlikely to get an outlier come into those processes and overpay. Whereas in, I suppose, newer markets with more recent entrants, I think you will continue to see some outliers who, I suppose, in the minds of some of the more established players, are overpaying.
But I guess sorry, go ahead.
Yeah, in the case of Spain, I could separate the unsecured versus the secure. In the unsecured, we have seen obviously the conversion. The prices were in line with expectations of the sellers. In the case of the secure, although they were small, mainly secondary, it took a bit longer, and there was a need of efforts from both sides, the seller and the buyer, to reach that conversion that was more natural within the unsecured spectrum.
So what does that say? Is it saying that the buy side is expecting a reduction in the pricing of the collaterals, which the sell side still doesn't expect, or is refusing to accept?
I think we'll meet in the middle. I think there's a lot of work being done by sellers to put in better preparation on the sell side. Obviously, the higher quality of data, the less uncertainty around a particular pool of assets will help sustain the pricing that they hope to achieve. So you can take measures as a seller once you decide you are a seller to prepare well and try and minimize that bid-ask spread by giving as much helpful information and useful information you can to the buyers to price that accurately.
If I may add something, I see the spread is still there because I don't see many transactions still happening. What we're trying to do, for example, is to maybe divide the big portfolio into segmented and asset type sub-portfolios and to address them to the right buyer. That will create actually a closing up of the gap and let the transaction go forward. On the other side, of course, maybe this will translate also maybe more in single names rather than big portfolio transactions. And the last thing that was mentioned, it is true that before we had like many years ago, we had only a few players. Now we have many different new players, even very aggressive. So the gap will be reducing, but from myself, I still will take a little bit time.
Okay, Declan made a very fair point in that when you're selling something, it's all about being explicit in information. So disclose, disclose, disclose. This is, in the way I see it, a non-systematic risk, which means that I have something to sell. I can be forthcoming with information which will help to bridge the gap, but we can still hold our differences when it comes to the value of the collateral. I'm in the property market, I'm in the real estate space, and I personally see some discrepancies in the values of the collaterals. If you think about it, the banks have the performing book to think about, so they cannot be too forthcoming, maybe accepting losses in certain sectors like retail or secondary industrial. From your experience, do you see convergence in these issues, in these areas?
Maybe
please.
Maybe I can mention a very interesting experience we had in Greece, actually, with this, because of the specific dynamic as well of the real estate market, which a few years ago probably touched the bottom and actually has been recovering since then. There was a case that, a lot of revaluation that the bank did was around this time of the rock bottom of the market. So there were many cases that we've seen in portfolios where the new valuation that we would perform would, in some cases, come even higher than what the sellers would have in their books. Again, due to the specific dynamic of the market,
Okay.
and in general, normal portfolio would look into, you would expect a certain divergence between the seller's valuation and what you would see in the market. And in some other CE markets, we would see 20-25% actually of lower value based on our valuation compared to banks would have in their balance sheet. But in Greece, again, because of the different dynamic and quite frequent revaluation of the real estate portfolios, which they were required to do in order to take a proper provisioning and recognize the losses, some of these valuations were really done at the bottom of the market, and actually we've seen a positive impact on the market. Now, unfortunately, a lot of buyers were quite bullish on that and tried to extrapolate that market growing quite quickly and quite a lot in the next years and build the cash flow projections built inside of that really bullish assumptions about the real estate market growth. And there is still a lot of potential for growth in Greece, but events like COVID would definitely delay that at best, slow down that. So that's why a lot of buyers got into a trouble, I guess. Okay.
In terms of information, so VDR, clarity, and so on, I expect that things have improved a lot since the first NPL transactions, and particularly in Southern Eastern Europe, where things are not done as institutionally perhaps as in Western Europe. have we now reached a satisfactory level of disclosure across Europe? So can we talk about the ability to underwrite as well in Western Europe as in Southern Europe, for example?
If I may answer, I mean, the quality information clearly is better now than before. I mean, we can even see when the seller provides anyway the templates already more or less in place. The term that you mentioned before about the real estate value actually is a big variable. And to be honest with you, the reason why I joined CBRE is exactly that. I wanted to have a better understanding, better knowledge on the asset itself. So that for me was a strategic join. This gap can create substantial issues. Now, the fact that to have better information doesn't mean that you are better valuing, because they also need to be able to understand that, that the data, try to elaborate them and try to get a good price or a reasonable price on the transaction.
Do we see uniformity in the way that data is prepared? So, for example, the EBA template, do you see that being rolled over or rolled out, or is it too early, or is it just theoretical?
In general, yes. I mean, there's quite a uniformity, but depends jurisdiction to jurisdiction, and depends also asset type, to be honest, because when some information may be more relevant for some kind of NPLs and less from others.
And I think advisors are playing quite a strong, helpful role in this regard now. The likes of, you know, the Elantra team that helped us in Ireland through KPMG and KPMG's continued involvement across Europe. They know what investors need to see, and they've built a business trying to create those information kind of resources for sales processes for investors. On the margin, the templates that the ECB and the EBA have been promoting are helpful to educate maybe peripheral players and smaller entities that may be looking to approach the market. But I think the more sophisticated, larger players will resource themselves and get across the line.
Okay. Other than the VDR, what sort of information sources are entering into the mix? So do we see, for example, behavioral data, which is something that the services might give us, but not the vendors?
To us, that behavioral data would probably be one of the most valuable pieces we could get, and it really varies by seller. So customer engagement in a resolution process is a key indicator of value to us, and if we can learn about that as part of a diligence process, it's extremely valuable and could be extremely valuable to the seller. It's unfortunately still quite rare that that's volunteered to an extent that would be useful. We've seen more of it coming from third-party servicing platforms who are more organized and maybe have a better ability to extract that type of data. We're seeing very little of it from the primary sellers.
Would you have expected any different? I mean, in the future, would you expect primary sellers to give you data sets on call center interactions, for example?
I'd love to say I expect it. I don't, as long as legacy systems make it difficult for them to easily extract that information. I just don't think they have an easy way to produce that information for us.
Yeah, okay. What we have seen is something similar. In many cases in which we advise or help the seller, we are asking for this kind of information that Declan just mentioned in terms of calls, SMEs, etc. So the collection activity data in most of the cases is not easily available, but it could be fairly an extra data point to value portfolios, but it's quite difficult to have that.
Yeah, and I guess the situation. Sorry, Burkhard, you were about to say something.
No, if we're gonna, sorry, very quick. I mean, the information also depends on the service you're actually gonna serve the portfolio, because when you make a pricing, make a huge difference. So that historical information specifically for the service, who's gonna service the portfolio, makes sense.
Okay.
And in terms of the EBA NPL template, I think it's a huge step forward to set a common dictionary to talk about non-performing loan data in a common way that is very comprehensive. It's well structured. Some people say it's overly comprehensive, but when we talk about these behavioral data just now, customer interaction data, they are not part of the EBA template. So I think realistically, just getting this incremental information that is already defined in the EBA template is a challenge. Payment data, historical payment data in the unsecured space, very important. And even that is not perfect. In most deals that we receive, yes, you might see the last 12 months in quite some granularity, but 12 months for a very well-seasoned portfolio is not enough. Yeah? You need to know what happens through the life since default or termination of the claim, including when the customer was, whether the customer is cooperative or when they have been last contacted, because it could also be the bank that they haven't followed up. Yeah? So I think EBA, the last working group late January regarding the EBA NPL template was attended by 100 participants. It's clearly getting more attention and traction now, the template. There is a survey out. I would encourage everyone to participate in the service and contact Christian Thun from the European Data Warehouse to participate in the exact details of the EBA NPL template. The large banks have not used it. It's true. Right now, it's not used much. We, on our platform, we use it. So we map every portfolio that we receive to the EBA NPL template, because that's how our backend work and valuation functions work. It's extremely useful, and the expectation now is that it will become mandatory, not 2021. The timeline is still uncertain because it depends on legislative processes, but it will come. So this is a big change in the NPL market in terms of data. In terms of data rooms, the information in the VDRs, of course, yeah, the market has learned and sellers have learned, and they are providing more information. But if you look at some of the scanned documents, they are barely readable by a human eye. They are so badly scanned. And then can you imagine how an algorithm is trying to extract information from that? It's very hard. So I think there's still a long way to go in classifying, sorting, identifying missing documents and doing that automatically. A long way to go. But of course, yeah, the template, the positive takeaway here is the template is extremely useful and well-defined. And even though there are 450 data fields, it's not that they have to be provided in an unsecured retail transaction. Yeah, of course not. Yeah, it depends on the asset class. It depends on the mix, whether the data fields that are defined are relevant. It is a dictionary that is very useful.
It's strange what you mentioned about scanned documents and unstructured data. I mean, given the advances in natural language processing and other fields of AI, you would have expected that it's in the vendor's interest to extract this information and structure their data. What do you guys think it's holding them back? It sounds like a no-brainer, actually, doesn't it?
Yeah, it's laborious, yeah, to have a very strong digitization of all your information. Courts often send you letters, yeah, and they have to be scanned, and the borrowers communicate by different means, yeah, by WhatsApp or email or letters, traditional letters, and capturing all that information systematically and making it a bit more structured or accessible by automated means is a challenge, and banks are very, say, experienced and good in their bookkeeping systems, loans. Yeah, they're very good in capturing cash flows, interest rates, and payments. Collateral information, real estate valuations, we touched upon many times in this call. It's not as good as it maybe should be. And when it comes to legal process, tracking legal processes in a workout, it's very much manual. It depends on the analyst, to what extent they are systematically scanning every communication with the customer and feeding the database with it. Some do it much better than others, and pretty much every data tape we receive is deficient in some way or form. Yeah, they have become better, and sellers know better what is needed.
Yeah.
But that doesn't mean that they can produce great information at the press of a button. It is still a big effort.
Okay,
What we
Emiliano,
have seen, Tassos, related to that, I think, is we are seeing more progress even in the servicing piece, mainly because of all the margins related business that makes you to be more focused on improving margin. And we have seen in the servicing, especially when you talk about documentation coming from courts, and how these communications are being managed through technology to have a proper reading, extracting information, and then feeding the management of the files. I hope that this should be extrapolated as well, or copy within the preparation for the asset sale in terms of the contracts, the real estate information that Burkhard mentioned, etc. But we are seeing some progress more in the servicing piece than in the sellers.
Okay. Is it easier to use big data in the valuation of collaterals as opposed to the servicing? So, for example, AVMs in mortgage valuation, is that now standard, or do you see discrepancies and lags in different markets? Maybe Emiliano, you're in CBRE, maybe you have a view, and Marko, you have various less developed jurisdictions.
Depends on seller to seller, legislation to legislation, asset type to asset type. I mean, I wouldn't be able to give you. The standard is higher, this for sure. I agree that it's more a work, especially digitalization, mostly on the servicer side, more than the seller, but it's been an improvement and quite good actually.
Okay.
Yeah, I also just wanted to comment in general about the data quality, is that we've seen a lot of improvement even in CE region, especially for the sellers that had previous sales. They have much better understanding of what the buyers want. We've seen some of them starting the first transactions with the advisors that would help them, and we would see in some cases consecutive sales being done without the advisors, and the bank would still maintain a decent level of data quality. Some of the lack of digitalization, and I think use of the tool is due to also the at least in our region, is I really think partially due to the backlog of these cases and how old these cases are. And I'm sure that when some of these loans were originated, because some of them are past due for 5+ years, so they were originated 7, 8, 10 years ago. At that point, there was not much developed NPL market in those countries. So the idea at that point that they will eventually sell those loans, that the value of these loans will depend on the quality of data, did not really exist. And I think that has changed a lot in the last few years. So I think that the new loans that are being originated are also being treated a bit differently. And another problem where we've seen quite often actually that the poorest data quality comes from the situation where there was a merger between the banks or another bank buying another portfolio. A lot of data gets lost in that transition. And again, more of that being digital, I hope less of that would be lost than when we have a consolidation in the market. So I think it's simply slow, and the banking systems are quite a lot of them are legacy systems, and they're changing much slower than what the technology is really available to do. They're just such a complex systems that few people are brave enough to change significantly technology that the bank uses in different areas.
Okay, we're approaching the end of our allotted time. I have a question that I thought I wouldn't need to discuss in such panels. Before COVID, I was hopeful that we would reach the end of the NPL saga and move on with our lives. But apparently with COVID-19, we have a new batch of NPLs. So the valuation of NPLs is going to be with us for some time longer. I mean, it would have been in the secondary market, but we are going to see a few more primary transactions as well. So if I ask you to risk a guess, how do you think technology is going to change NPL valuations over the next 3 to 5 years?
I think the answer is what Marko was mentioning. Depends when this loan gone to default, when they were originated. More recently, clearly they have better data. Older loans, they have worse data.
Yeah, I agree. I don't think we'll expect the tail to wag the dog here. I think once the bank's loan origination systems begin to capture this data and use these new technologies, we'll see that flow through to sales processes. But in terms of I suppose the market going forward, we at LCM, we're a through the cycle investor. We like to enter a country and stay through the cycle, not just for the crisis. And we build a business around the recurring emergence of a low level of NPLs over time. We'll take it, we'll participate in the larger processes when they arise, but we like to partner with financial institutions. And I think it's at that end where you'll see the incremental improvement over the next number of years.
Brilliant. Any last comments or any insights anyone would like to offer?
Well, I think one interesting development because of COVID, and you have this huge volume of government guaranteed loans and I think in the UK, the British Business Bank is predicting up to 50% defaults on certain COVID guaranteed loans. So clearly that means that you have servicers and investors actually operationally responsible for a large chunk of loans that are doubtful or non-performing, whereas a risk taker is someone else, is someone who has no operational involvement whatsoever. So that will be interesting to see how that plays out. And of course, countries are aware of it and thinking of bad bank type of solutions or servicing solutions that are more centralized. So that's a completely new aspect specific to the COVID crisis that we didn't see in previous crises. In terms of technology, I think again having the European Commission, having the ECB support a data standard, that means the banks, even the smaller banks, the second and third tier banks, they know what to work towards too. Yeah, they have now a language that they need to speak in terms of their non-performing loans, and that will help. In addition to just better available technology for pricing, automated valuation models. Certainly on the residential mortgage side, they are useful. And actually also very efficient. You can automatically get your pricing. You pay very little per property, and the quality is improving and quite decent already. So technology on the VDR, we have to see. It's a much harder problem to extract information, high quality structured information from unstructured data. It's a very hard problem when you have a large variety of different documents of different quality, different languages, different legal systems. That is going to happen. It's happening now. There are specialist due diligence fintech companies that do nothing but using artificial intelligence in due diligence processes. But it is not a quick fix. I don't expect a quick fix. The problem is too difficult to fix quickly. So there's the wave. I think there's also different, or every crisis has their sectors which are particularly hard hit, and this crisis is similar. That overall the recovery has been maybe even faster than expected. Yeah, certainly when you look at equity markets and most debt markets. But there are problem sectors, accommodation and food, transportation, airlines, tourism. They are not expected to recover very quickly. They are in a very difficult space right now, and that's where most of the NPLs will come from. And so specialized investors, servicers who have domain knowledge for these sectors, they should come to the forefront and do very well. Okay.
Burkhard, I ask you to risk a guess, and you very cleverly disguised it in what you said. You said bad bank. So do you think that's happening?
Yeah, it's a European level. I think there was a miscommunication late 2020 that allegedly there was significant progress on a European bad bank. I don't get that impression. I don't think so. The Commission, from my discussions, is taking that topic seriously, but they are setting standards for national authorities to set up bad banks in the countries, and that's what we may see a few more bad banks for sure, but a central European bank is probably too ambitious and maybe also not necessary, given the different local problems that individual countries are facing. If you look at Nama, if you look at Sarab, these were real estate-driven bad banks in Spain and Ireland. But EMCO, for example, in Italy is quite a different outfit. They have a very different book, and so, in my view, it makes perfect sense to have a much more tailored approach to the problem that we face in the country.
Makes sense. Makes sense. Gents, any closing remarks? Anyone wants to contribute something?
I would just say I agree with Burkhard there. I do think that there is an opportunity for maybe national bad banks, but the coordination issue of cross-border subsidization, it will just be a bridge too far, even within the EU. We've had a good experience with NAMA in Ireland, again, but very well underwritten initial valuations that allowed a recovery and a pull to par, if you will. It'll be a very different game with SME, non-performing SMEs as a result of COVID. It's a very different asset class, so very challenging.
Before we close, Marko, Emiliano, Antón, any final remarks?
Yeah, in my case, if I may, I'm completely aligned with what Burkhard and Declan saying in terms of bad bank. In terms of technology, directly for the valuation as well, what my peers mentioned in terms of the big difference would be the sellers. But I think there will be even a faster indirect effect of the technology that is through the servicing. I think the technology is changing the servicing, and this would affect what are the curves and expectations going forward. So this would be affecting indirectly what is the valuation. I think it already happened, and probably with the COVID situation is being accelerated, this effect of the technology in the servicing piece.
Brilliant. Yeah, makes sense. Makes sense.
I can just add in terms of the cycles and when we're going to get rid of NPLs. I guess not anytime soon. I think we're just kind of in between two cycles, and all of us know that the cycles will follow economic cycles. So we are definitely at the beginning of a new and exciting cycle in I think across Europe. So that will probably keep us busy for the next few years. Our expectation is that a big wave is going to come to the market either late this year or early next year. And yeah, I think it's exciting times in front of us.
Emiliano, I won't forget you this time.
Yeah, just very quickly, I think if the previous crisis we had the peak probably in 2016, so it's about 7-8 years later. So I would expect this one to be even slower. So I think we're going to expect very interesting times in terms of NPLs. This is a personal opinion, we'll see.
Interesting times, that's a tricky word. Wonderful. Well, gentlemen, I found this discussion very exciting and very insightful. I hope you enjoyed it as well. I'd like to extend a big thank you to everyone. Antón, Burkhard, Declan, Emiliano, and Marko. Thank you all very much, and wish us all success in the next NPL cycle. Thank you very much, and speak soon.
Thank you, Tassos.